Welcome to RBC's Markets in Motion podcast, recorded May 28, 2024. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, small caps are retesting their relative low versus large caps once again, as Fed rate cut optimism has faded. We remain neutral small versus large for now. Second, investor sentiment has almost returned to the highs in place to start the year, as well as the summer of 2023 on AAII, reinforcing our neutral stance on the broader U.S. equity market for now. And third, our S&P 500 valuation model continues to suggest that the broader U.S. equity market is fairly valued, with some modest downside risk if current inflation, interest rate, and Fed assumptions end up being too rosy. For a material move higher in the market year-end to be justified on the math, we think investors need to start focusing on the outlook for 2025, where visibility still seems a bit limited. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that II season is starting soon. If you found our work helpful, we appreciate your vote in the portfolio strategy category. Voting begins June 3rd and lasts through the end of the month. Now the details. Let's start with takeaway number 1. Small caps ended last week retesting their late 2023 and early 2024 lows relative to the S&P, as Fed optimism faded again. Small caps last made a relative bottom versus large caps in mid-April, and in early May were attempting to rally on the back of renewed Fed cut optimism. That rally once again proved premature. We've been telling investors we'd prefer to stay neutral on small versus large for now. While we thought small caps could benefit from continued improvement in domestic GDP forecasts, we felt like some investors had gotten a little too optimistic about cuts after the last Fed meeting, and reminded investors that small caps tend to inflect relative to large after cuts began, not before. We also noted that while small caps looked intriguing on positioning, CFTC's weekly data has suggested small cap futures positioning has been down around SVB lows again, that valuations had gotten less appealing, with the Russell 2000 forward PE back up to its long-term average of around 15 times. Earnings dynamics have also been better for large caps lately, particularly on earnings estimate revisions, which have favored the S&P over the Russell 2000. Moving on to takeaway number 2. Investor sentiment on the AAII survey is almost back to its late summer 2023 and early 2024 highs, or 1 standard deviation above its long-term average. In last week's meetings, we noted that one of the things really bugging us about the market right now from sort of a shorter-term tactical perspective was how net bulls in the AAII survey have been tracking around 17% for the past few weeks. It was just a matter of time, we thought, before this widely followed gauge of investor sentiment got back to 1 standard deviation above its long-term average, the level that was in place last year in late July and early August before the S&P embarked on its 10% drawdown. This was also the level in place as 2024 began. Historically, the S&P 500's return on a 3-month forward basis has been a little better than flat from these kinds of levels. In last week's update, the weekly data point, which we acknowledge can be volatile, rose to 20.7%, just shy of the 1 standard deviation mark of 22.1. With that reading, the 4-week average has moved up to 15%, still dragged down by the 6% reading in place at the beginning of May. Rather than alleviating our concerns, all this does is reinforce to us how rapid the recovery in sentiment has been. We'll wrap up with takeaway number 3. The S&P 500 continues to look fairly priced on our valuation model, with modest downside risk if current inflation, interest rate, and Fed assumptions end up being too rosy. For those who aren't yet familiar with it, our valuation model is somewhat unique. It forecasts a trailing PE for the S&P based on consensus assumptions for inflation and interest rates by leveraging data back to the 60s. We update this model weekly and note that consensus views on these macro inputs have shifted a bit. Expectations for how much inflation will moderate, how much the Fed will cut, and how much 10-year yields will fall were all reined in a bit and are now closer to the view of RBC's U.S. rates and economics team. The model is now projecting a year-end trailing PE of 21.5, down from 21.8, which implies an S&P 500 price of 5,100 to 5,300, depending on whether one plugs in RBC's 2024 EPS view of 237 or the 2024 bottom-up consensus of 245. Importantly, our stress test that bakes in no cuts, stickier than expected inflation, and higher than expected 10-year yields points to slightly lower PE at 20.8 times and a range of 4,900 to 5,100 on year-end S&P pricing. It's worth noting that the investors we met with last week, mostly long-onlys, were generally in the no-cut camp, which we confess is the view that we on the U.S. equity strategy team lean towards as well. The idea that cuts aren't coming anytime soon didn't seem to faze them much, however, as they also tended to believe that the U.S. economy, particularly their local economy, is quite strong. As we discussed what could drive stocks higher between now and year-end, it became clear to us that a focus on 2025 seems needed to take the market materially higher from here. And there, visibility still seems a bit limited, with one investor noting that the November elections may be contributing to the fog. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.